Welcome back, everyone, to the Risk Intel podcast, powered by SRA Watchtower, where we share risk intelligence with experts from across the banking industry. I'm your host, Ed Vincent, CEO at SRA Watchtower. Hello, welcome back to the Risk Intel podcast. I'm extremely excited to have Shawn Ryan return to the program with us today. Shawn, welcome back. I think this is your first episode in season 3, so it's great to have you back with us.
Yeah, thank you, Ed. I think the last time I was on the podcast, I told a scary story. I don't think that is the agenda today, but I'm happy to be back and thrilled to have another conversation with you about risk management at financial institutions.
It's a great plug there, Shawn, trying to drive traffic to your prior episodes.
Oh, you
It's a little bit of friendly
you found me out.
There you go.
Yeah.
But it is great to have you here in the mix. As a refresher for folks, Shawn, you look after the finance area of responsibilities at SRA Watchtower, but you also wear the risk management hat as the risk officer of the business, and had worked in financial institutions yourself on the front line. So you bring a nice varied perspective there.
Yeah, absolutely.
One of the things you also just did was you were also just speaking at to a leadership group at the Darden School about risk management. So I think we'll probably draw on some of the themes which you shared with that group as well. All right, Shawn, our topic today is to really think about why a financial institution CEO should prioritize ERM in the first place. And right, there's a lot of discussion around credit unions and banks looking to innovate and modernize their operations and infrastructure, and why compliance and risk management are really no longer check the box exercises. They really are tied to strategy, and a robust ERM program can do just that, right? It can be a differentiator in the marketplace. So let's start by exploring the top risks that a CEO should be concerned about today, right? There's a number of different factors and risks that a CEO would care about. What are the things that you hear about in your travels?
Well, so the first thing is this the actual economic or environment that exists around financial institutions in the United States, right? There's inflationary pressures over the last couple of weeks. We've seen kind of a downturn in the stock market. Although if you talk to anybody, you'll see that earnings are still robust. Maybe the biggest risk for any organization, whether they be a financial institution or not, that needs focus and management is cybersecurity risk or information security risk. Kind of two others that I would throw out there that are just on the radar for folks that I've spoken with and met with is the ability to attract and retain talent to the team, right? There's an increasingly free agent society out there where people are willing to change roles and change occupations relatively quickly. That makes it more challenging to attract and retain talent. And then the last thing, and Ed, you and I talk about this all the time, is how do you utilize artificial intelligence to drive innovation in your financial institution? And all those things are obviously, some of them are risks, some of them are opportunities, many of them are both. But the point there is that those are ubiquitous across all industries and all types of financial institutions, and things that the CEO needs to be thinking about and talking about with his board and his leadership team, or her board and her leadership team.
Shawn, there's a wide range of items there. Some of them are more emergent or more intense or more apparent at this moment in time. But one of the things that it seems to me that has been a consistent theme, and certainly something that I've heard about over the last couple of weeks, talking to folks in the market, is that many of those risks are thought about in a siloed manner. They're thought about, independently, autonomously on a standalone basis. But if you're the CEO, right, you're the leader of a financial institution, right? Your job is to break down those silos, right? And so perhaps you could talk a little bit about the concept of breaking down those silos, thinking about them a bit more holistically.
Well, sure. One of the things I said to the folks that I met with at the University of Virginia's Darden Financial Institution Executive Leadership School was that without an enterprise level risk management program, the natural silos within a financial institution preclude effective risk management. It's not that we don't want the silos to exist, right? We need the credit team to manage credit. We need the operations team to focus on the efficient and execution of the operation. We need obviously the CFO and the finance team to close the books and to manage compliance with regulation, et cetera. But the nature of the risks that we just talked about is that they breach the silo, right? They stretch beyond the silo. They extend outside of any one of those silos and impact all of the other operations, all the other domains in the bank. And so without a way for the CEO to see risk aggregated at the top of the house, they don't know whether the talent issue, for example, exists only at the underwriting function, or it actually has now started to spread beyond the underwriting function, and it's bleeding into other aspects. It's bleeding into the branch, or it's bleeding into other aspects of the institution. And so the aggregation of risk at an enterprise level is the only way for the CEO and the leadership team and the board to understand how risk is not just specific, but how it's more broadly impacting the organization. Of course, that's where understanding that is where how you prevent unintended events from occurring, or how you implement actions or risk management strategies or other forms of strategy in order to take advantage of the opportunities that exist across the organization. I want to say something about strategy tied to risk, but I'll wait maybe for your follow-on question.
That that is the following question, right? You indicated there, right, that there is a whether you want to think of it as a carrot and a stick or kind of a pro and a con, that right there is the avoidance or prevention of unintended consequences. But then there's also taking advantage of opportunities, as you I think very clearly put that, and taking advantage of those opportunities as well as preventing the unintended consequences really is exactly as you said. That's the intersection of risk and strategy, right? And we talk about those two concepts being two sides of the same coin. So yes, I'd love you to unpack that.
I start a normal presentation in risk management, which I do from time to time, when Ed, the CEO here, lets me out of the CFO's box. But right, we all went. Most of us took a class in finance at some point in our career, and risk and return are two axes on a graph, right? And I start the class that I've spoken at before, asking how do you measure success of your financial institution, and it's usually very easy for folks to rattle that off, right? They talk about return on average assets, return on equity, earnings per share. They talk about NPS scores when they're thinking about how they measure the success of their clients. They might talk about deposit gathering or loan origination scores. All of those things are ways that the financial institution ensures that they meet their strategic objectives. Well, guess what? All of those things, key performance indicators, if you will, can be converted or looked at through another lens as key risk indicators, right? So if you have a loan origination target and you're not hitting it, well, that's a key risk indicator, right? You have a target, you've established a threshold. It is a key performance indicator, but at the same time, it is also a key risk indicator. If you're not achieving the goal that you set for that, now you have to dig in and understand why. And only by doing that, going back to the comment that I made previously, maybe it's a people issue. Maybe it's a talent issue. Maybe it has nothing to do. Maybe it's an operational issue. Maybe you've got a bottleneck in your operation that's not allowing the loans to flow through. So only by looking at risk at the top of the house are you able to achieve your strategic objectives at the top of the house. And so, I always say risk strategy is a natural component to corporate strategy. It is a component or a complement to, natural complement to corporate strategy.
I like that. I haven't really heard that phrase before. That risk strategy is a complement to the broader strategic plan there, and the financial strategy and the operational strategy, right? I think that's a great way to characterize it. You've worked in institutions yourself, Shawn, right? Where you've seen this in action. Could you share an example with us of a situation, a real world example where an institution has leveraged ERM to, as you said, right, bring risk strategy up there to elevate it to that level?
Well, one of the financial institutions that I worked at was very much a credit-driven organization, right? Its bread and butter was making exceptional credit decisions, and the challenge with that was that the credit decision was just to our prior conversation was very siloed, right? The credit folks were the the stars of the company,
Right.
and yet when we grew and we continued to go through regulatory exams and whatnot, we found that none of what was happening in the credit organization was linked to the rest of the organization. And so there was no connectivity between what was happening in credit and what was happening in, probably most importantly, deposit gathering, right? And so you were making so many loans, but you didn't have the funding to be able to support those loans in the long run. And so you had to borrow money effectively in the broker deposit space, or through other mechanisms in order to generate the deposits that you needed to make those loans. Well, by not having that connectivity, it became increasingly difficult to get a good spread, right? Banking is a spread business, and so you had to pay too much for the funding source for those particular loans that we were making. Even though we were making great credit decisions, we were basically originating too many loans given the funding that we were able to achieve. And so those kinds of things happen in a lot of institutions. It's just this disconnect between the strategy and the risk management and the inability to understand what's happening in other parts of the organization, which is why, I think a CEO, she has to have a good handle on what's taking place across the entire risk spectrum. The other thing that I would just bring up that is really important to the CEO is the cultural dimension here, right? You want
Mm.
in that example that I just gave, you want the deposit people to raise their hand quickly and early and say, we can't generate enough funds for you to make these loans. Well, you don't want to wait until that becomes a problem till you face some type of regulatory scrutiny, like your cost of funds is too high, or you're growing too fast and you don't have the controls in place, right? You want other organizations within the financial institution to raise their hand and say, look, we've got a risk over here. It's going to impact our corporate strategy. It's going to impact the achievement of our objectives. And we need to call that out, and you need to see this. And so that's why, the CEO sets the tone of risk culture in an organization and has to elevate that to the same level that they elevate, financial management and credit management and people management, regulatory management, all those things. Enterprise risk has to operate at the same level as all those other domains within the institution.
I think that culture of risk is a theme that we've heard multiple times, and really important. And as you said, right, it ultimately is what allows you to tie risk to strategy. If you've got a culture of risk, it allows you to then tie those risk and strategic concepts together and ensure they are going to be enacted in the way that you expect them to be enacted, because the whole organization is going to buy in and support that.
Yeah, without a strong culture, ERM is difficult at best, right? You have to empower the front line to raise their hand. You have to clearly articulate the three lines of defense and who is responsible for what within there. You have to give the CRO a seat at the table. Far too many organizations, the CRO wears a chief hat but sits one layer below the rest of the chiefs. Like,
Right.
I'll reference my Halloween story, right? That was about a CEO who didn't believe that they needed specific attention on risk. Um, the line that I talked about earlier with the two axes, risk and return, you can't achieve a specific or an expected return without taking on the equivalent expected amount of risk. And if you're too high or too low, you're not going to hit your goals. And that's why enterprise risk management, the ability to understand holistically what your risk looks like for your institution, is the only way to ensure that you achieve your goals. And there's, you know, we've talked about this before, Ed. There's some secondary benefits too, if you want to talk about that as well.
Well, I'm gonna actually ask you to hold those thoughts because I want to come back in
Okay.
our next episode and talk a little bit about those, but also talk a bit about kind of the forward-looking piece and forecasting and where are we going and how do you use risk management to plan for the future.
That sounds great. I look forward to another conversation with you, Ed.
Great. Well, Shawn, thank you. Thank you for getting this concept back up to the surface, right? The idea of aggregating risk at the enterprise level, preventing unintended consequences, and taking advantage of opportunities, and really resurfacing this concept of risk and strategy being two sides of the same coin, right? That risk return, right? Those two axes as you laid out there. That's right. That's the starting point. We've got to begin with that.
Yes.
And then make sure that from the top of the house, the CEO is setting the right tone and setting the right culture of risk. Thanks, Shawn.
Thank you.